Our last contributor today is Rowena Bethel. Rowena is a top experienced corporate and public governance specialist with an impressive track record in the international affairs environment. 9 years as the representative for the Bahamas at OECD, Global Taxation Forum in Paris, 14 years with UNO in Geneva and New York, whereas the last 8 years as a member of the Committee of Experts in Public Administration in New York. At the same time, she was the CEO of the National Insurance Board of the Bahamas, and besides all that, she has had even her own company as a regulatory consultant. But of course, she has affinities to Sub-Sahara Africa. That's why she's here today. She was a board member of the African Innovation Foundation, and she still is a member of the CAFRAT, the African Training and Research Center. Here is Rowena Bethel to talk about managing regulatory risks.
Thank you, Stefan. Okay, while we're waiting for that, I just want to say that it's a brief presentation, of course, because I stand between you and the rest of your afternoon, somewhat, intended to provide a high-level introduction into the organizational structure of the global regulatory landscape for financial services in particular. We would have heard a lot today with respect to investments, and investments particularly in Sub-Saharan Africa, which is all wonderful. It's something that we can look forward to. However, there is a certain rules-based system within which global finance occurs, and it's important to understand those and why linkages and relationships with the UAE in particular would make a difference. Okay, the concern largely is about the integrity of the global financial system, and it's primarily twofold: that of managing cross-border financial crimes risks and also tackling and stemming illicit financial flows. In the remaining slides, I'm going to highlight the main actors in these efforts, the standards and their overriding principal objectives, and the impact that these have. I will conclude with a few recommendations on how these risks might be managed by sub-Saharan countries. Now, the main actors, I have up on there 6 boxes. The first 4 boxes, the larger of the boxes, multilateral institutions, essentially. The first, and obviously I think the one that dominates most of consciousness at the moment, is the activities being carried out by the Financial Action Task Force, which is headquartered in Paris. It's a multilateral agency with about 35 or so member countries dealing with developing a framework to manage, control, and tackle anti-money laundering activity in cross-border transactions and terrorism financing. The second, which I think is worth mentioning here, is the OECD's tax information exchange initiatives. These are important because they impact significantly activities of multinationals, and of recent times there has been a lot of new developments on that front with respect to ensuring that, as regards tax obligations in multi-jurisdictions, that there is in fact the payment of the various liabilities that exist. Basel Committee, the other 2 boxes actually cover prudentially regulated organizations or organizations that develop standards for prudential regulation in the banking, securities, and insurance sectors. The last 2 I highlighted are the EU and the United States, and I did that purposely because in addition to being extremely influential in the other bodies that I would have identified, the other multilaterals, they in fact implement distinct and separate programs themselves dealing with money laundering, anti-money laundering, as well as tax cooperation. And they have joined the bandwagon of issuing lists against countries that they consider to be non-compliant with the standards that they themselves have promulgated. Very quickly, just to give you a snapshot of what the composition of the bodies look like, the OECD, the FATF, the EU, and G20 members. The United States, it's in there. The reason that I highlight this is because you will see that the only Sub-Saharan African country in the mix, in fact, the only African country in the mix, is South Africa, primarily because of South Africa's membership of the G20. But what it does is it says a lot when those who are developing the global standards don't include everybody to whom the standards necessarily applied. Now, the standards themselves, the FATF, which is the anti-money laundering multilateral body, issues 40 recommendations. This is done in conjunction with the G10, and G20 now, the World Bank, the IMF, and the FATF. Often, and I raise this also to point out the force and the collaboration that occurs in relation to these standards. Often when I've presented in the past, people are not aware that the IMF and the World Bank are very much behind the development and the implementation of these standards that are promulgated by FATF. In relation to exchange of information, we see a similar sort of behind-the-scenes collaboration and influence. That's at the OECD level with the G10 and the G20 again, with the United States and the EU. And of course, in terms of prudential regulation standards, what we're looking at is organizations of regulators, global regulators that meet together, but by and large, again, they do not include necessarily sub-Saharan African countries, with the exception of South Africa. And these are the agencies, these are the primary global standard setting agencies that one would encounter. Now, the broad themes of the financial crimes standards and principles are, first of all, that regulation should be risk-based. And this was an important change in 2012 because before, standards were issued and they were highly prescriptive. In a lot of instances, they really were not relevant in the context of countries outside of the grouping that would have developed the standards themselves. So they very quickly came to their senses and realized that not every country necessarily has the same types of risks. And therefore, we moved to a risk-based approach in which countries are invited and asked to assess their risks in the area of particularly anti-money laundering or money laundering, and to develop regulatory responses or remedial responses to those specific risks, and not necessarily to assume that their risk is the same as it might be in London or Zurich or New York or Toronto. Secondly, there is a desire to, in fact, criminalize the activities. For a long time, many jurisdictions did not criminalize activities to the extent, including those in the OECD countries. They simply did not have it. So there was a big move to criminalize activity, and a list of offenses that underlie, which are called predicate offenses for money laundering purposes, were developed as part of the FATF anti-money laundering standards and recommendations. One of them actually, which is why I keep referring back to the OECD, refers also to the issue of tax evasion. Third, transparency. That's essentially customer identification, record keeping, monitoring, filing suspicious transactions report. Critical in understanding who are behind the movements of funds around the world in order to be able to deal with those cases where it's deemed that there may be illicit transfers. Fourth, adequate regulatory and enforcement infrastructure. Now, in this area, I've found that the sub-Saharan African countries and a number of Caribbean countries and in many other emerging and developing countries have not done as well. The cost of regulation is extremely high. It is very labor intensive, and many jurisdictions simply don't have the wherewithal at their disposal. Notwithstanding, some of them run the risk of being named and shamed, and that has significant consequences for them. And finally, of course, all of this essentially is in an effort to ensure that there is an adequate conduit or adequate conduits around the world between countries for sharing information, providing assistance with investigation, and collecting and identifying who is behind or who is at the source of money transfers in particular. Now, the impact on countries, I think the biggest impact, and I speak from personal experience, is that of naming and shaming. Naming and shaming has the most undesirable effect of interfering with financial services, cross-border financial services. Large institutions, particularly banks, become very nervous dealing with persons or institutions or companies, corporate entities in countries that have been named and shamed. As a result, therefore, it's important that, because all countries eventually, the idea is to have all countries a part of the framework, so they're all subject to periodic assessments, with the view that at the end of the day, there's no country that becomes a haven for illicit activity. This creates a huge burden on many of the emerging economies and economies in transition. And I know the most current named and shamed list for the FATF, which includes the Bahamas at this particular point in time, also includes Ghana and Ethiopia, and that has significant, and it did include Kenya and a couple of other African countries, Botswana at one point in time. It does interfere with the flow of money in and out of those jurisdictions. It affects accessibility, it affects the ability of businesses to conduct activities cross-border. And I think the worst effect of it all is where they begin to de-risk. And essentially that's where large banks who are afraid of or who are concerned about regulatory reaction in their own jurisdictions decide that it's simply not worth the headache offering services in jurisdictions that have been named and shamed. So they literally withdraw financial services, a huge impediment ultimately to trade. Now, my recommendations for dealing with this, and obviously I have addressed it in this presentation at an extremely high level. There is a lot more kind of underlying detail and information that is important to understand the context. But my recommendations are, first of all, undeniably I feel that there has to be an increase in representation on the various multilateral standard setting bodies where there is influence. Within these bodies, there are different levels of committees that have decision-making power. And to me, the representation is not reflective of the constituent that these bodies concern themselves with, and that is the world. So I do believe that, for example, in the FATF, we could see more African countries represented, Sub-Saharan African countries represented in their steering groups and in their peer review groups. I feel that there is a need to pursue public governance realignments. We would have heard today on several occasions the issue raised about having the proper policy framework and the public sector responsiveness to private sector and industry developments. I believe that a lot can be done in terms of adopting the United Nations Sustainable Development Goals, particularly SDG 16, which focuses on building effective and meaningful public institutions. The approaches that are adopted within SDG 16 is approaches like participatory governance, greater transparency, access to information that help to create the openness that facilitates a sense of certainty and a sense of reliability about how decisions are made within government on business activities. My third recommendation is that there should be an enhancement in Pan-African responses. What tends to happen is countries are blacklisted, the country reacts. But I believe if 46 voices are raised against multilaterals, they will listen far quicker than they will listen to just one voice. So I believe that Pan-African responses to all of these initiatives is an imperative. And finally, I talk about exploitation. In the good sense, I believe that the regional and hemispheric synergies can work to the advantage of Sub-Saharan Africa, and I believe that that sentiment has been endorsed earlier. The regional, Dubai is a financial center, and it's a well-respected financial center. Operations and services offered out of Dubai are likely to receive less resistance than services necessarily coming from countries in Sub-Saharan Africa that have been named and shamed, whether we agree with it or not. So I do believe that this is one way to address opening up and maintaining those avenues for trade outside of the Sub-Saharan African region. Compliance, as we know, is pretty much a huge buzzword. Investments and compliance, I think, go hand in hand. It's almost impossible to separate the two, and therefore there is an imperative that this is taken into consideration in terms of how the future for growth in Sub-Saharan Africa is to take place. Acknowledge and deal with the fact that perhaps the representation that's required at the levels where these negative or adverse ratings are occurring needs to be addressed in order for, I think, there to be fairness in the playing field. Thank you very much for your attention.